When markets knock your portfolio out of shape, should you rebalance? This video dives into when rebalancing helps and when it can backfire. I was surprised by how dramatically the impact of rebalancing changes depending on your stage in the investment lifecycle. Let's see if it surprises you too. This video is sponsored by Trading 212, a UK commission-free investment platform. So why bother to rebalance in the first place? I think it's best to illustrate that with a really simple example where we've got £100 to invest and it's 2003. We put £50 into a global stock fund and we put £50 into a UK government bond fund. And then we just leave it and see what happens. Now, as many of you know, stocks generally outperform bonds, particularly over the long term. And that's precisely what we see here. Now, overall, the growth of the portfolio is pretty good. It increases from £100 to £358. But notice what happens in the bottom panel. There I've shown you the allocation to bonds and to stocks. And you can see that gradually what happens is as equity outperforms, it forms a larger part of your portfolio, such that you start off 50-50, but you end up with an 80-20 portfolio, just under. So 80% is now invested in stocks without you having to do anything. Now, the longer you leave it, the more dramatic the change is going to be. But even over this fairly short time period, you can see that the portfolio can drift a lot. Now, you might be thinking, well, I know that equity generates a good long-term return, better than bonds. So by having greater amounts of equity, surely that's a good thing. It actually increases my return long-term, which is true, but there is a drawback. And this is the case for rebalancing. Now, I'm not saying this is going to happen, so don't panic, but let's say that we take the global financial crisis, and you can see the dashed vertical lines here, the white ones, which delimit the global financial crisis, and we take those daily returns for stocks and bonds and simply replay them, starting from where we are today. But here's the key point. We start from the new allocation, which is 79% equity, rather than roughly 50-50 equity, which is where we were when the crisis first happened. Notice the really dramatic fall in the value of the portfolio. The dramatic nature of that loss becomes much clearer if we compare it to the previous all-time high. So this is often called a drawdown plot. Now you can see the first time around, when the global financial crisis actually happened, this 50-50 portfolio would have fallen by around 23%. Whereas now that it's almost an 80-20 portfolio, it falls by almost twice as much. It falls by about 37%. So while we were quite happy to ride the good returns and to have a greater amount of equity in our portfolio during the good times, inevitably there comes a pullback. And the reason why we chose a 50-50 portfolio, presumably, was because we don't like volatility. We don't like losses. Also, if you have a diversified portfolio, you get better risk-adjusted returns. In other words, the units of return that we get for every unit of risk that we take to generate them is better if you're diversified. If you don't rebalance, because equity comes to dominate your portfolio, that risk-adjusted return deteriorates again. And it's likely that our risk appetite won't be in line with the asset allocation that we end up with. But it's not all about managing risk, it's also about return. You can actually harvest some extra return by rebalancing. Intuitively, that makes sense. When there is an equity market crash, what you'd end up doing is to sell the thing which hasn't crashed, usually bonds, and buy equity at depressed prices. Now we know that that usually gives you a better return than buying equity at elevated prices. So intuitively, you might expect that if you do this rebalancing, it would generate a bit of extra return. We'll put numbers on that later on, depending on our strategy, but it is true that you can harvest volatility premium. Now, there are certain portfolio criteria to get the biggest bang for your volatility buck from rebalancing, and that's twofold. The first one is that you have volatility in the first place. The more volatile the assets, the greater the rebalancing benefit. The second criterion is that the investments in your portfolio should be uncorrelated. If that's true, then there will be uncrashed assets such that you can sell those to buy the crashed assets when the crashes occur. If everything's highly correlated, then it's going to all crash together and you won't be able to use your capital efficiently this way. So this is the concept of dry powder. If everything's correlated, there won't be any dry powder. Now, before we look at when rebalancing helps and doesn't and how to do it, I'd like to talk about Trading 212's ISA. And today's video is sponsored by Trading 212. I've been using Trading 212 stocks and shares ISA for a few years now, and I love the platform. And here's why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I have on Trading 212. Trading 212 offers over 13,000 ETFs and stocks from the UK, US, and Canada and Europe. And finally, it leads the way with new functionality all the time. New features are being rolled out continuously. For example, it offers fractional shares, pies, and auto investment. If I had to choose my favorite feature, it would probably be pies, where you can create portfolios within your ISA. Now, today's video is about rebalancing, and if I want to rebalance one of my pies, I can do it with just one click. You can also fund your pie using regular investing via direct debit, and that encourages good habits like regular saving. You can also reinvest any dividends back into the pie automatically, and that can also be used to rebalance the portfolio. Now, Trading 212 charges no account fees whatsoever on their stocks and shares ISA. Their ISAs are flexible, which means that within a tax year, you can withdraw cash and put it back into the account without affecting your ISA allowance. Your money's kept in a segregated account and protected by the Financial Services Compensation Scheme up to a value of £85,000. Now, as a viewer of PensionCraft, you get a special offer from Trading 212, where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, R-A-M-I-N, and you'll find a link to that offer in the description below. Now let's get on to the practicalities of rebalancing. And broadly speaking, there are two approaches. Now, these are calendar-based and threshold-based. Now, for the calendar approach, it's very simple. Every period of time, you rebalance your portfolio. So that might be weekly, monthly, or even annual. The second approach looks at deviations of your portfolio from the desired allocation. So in our original example, we had a 50-50 portfolio. What you could say is, if we get to, say, 55% for one asset, 45% for the other, at that point, when we've drifted 5% away from my target, that's when I'll rebalance. Or you can do a combination of the two. Every year you could say, I'll rebalance, but only if I've drifted a certain distance from my target weights. Now, the benefits of rebalancing depend critically on not rebalancing too often. And that's because the costs of rebalancing usually increase if you rebalance more frequently. So let's take an example where we've got a stock bond portfolio. In this case, I've got an S&P 500 tracker SPY combined with an intermediate US Treasury fund, IEF. So the blue line shows you the bond cumulative return and the red line shows you the stock cumulative return. And then the yellow line is the rebalanced portfolio. Now, the dashed vertical lines show you when the rebalancing events occur. And if you look in the bottom panel, you can see the allocation between stocks and bonds. We start off at 60%, that's our target, 60% stocks, 40% bonds. And if we drift 5% above that for the stocks, then we rebalance back to 60%. And if we drop to 55%, again we rebalance back to 60-40. Now, I've chosen this threshold deliberately to be fairly tight, and that's because you can see the result, which is a lot of rebalancing. Notice that it's not equally spaced in time. In this case, I haven't looked at calendar-based rebalancing, it's purely threshold-based. And during periods of market volatility or during very strong rallies in equity, you can see that those rebalancing events occur very frequently. So if you want to minimize the cost, but also the effort of rebalancing, you can set those thresholds to be a little bit wider. So here you can see what it looks like if it's 10 percentage points above or below 60%. Instead of the previous 16 rebalancings, now we've only got 5 of them. Now, of course, as a finance nerd, and I wonder if you're one too, we'd like to know what the optimal frequency for rebalancing could be. And fortunately, there's quite a bit of research on this, which I'll summarize. For example, there's a nice paper by Vanguard, this was published in 2022, which looked at optimal rebalancing. So if you go for calendar-based rebalancing, you can see that the optimal period, in this case at least based on their analysis, is annual. So not very often at all. Now you might be thinking, I'm on a commission-free platform, my trades don't cost anything. Well, actually they probably do, because there's a bid-offer spread. You always end up buying high and selling low. That's the way market makers work. That's how they make their money. So if you trade a lot, say you're rebalancing daily, then you'll be continually crossing that bid-offer spread and eroding your returns. So there's a trade-off here between keeping your portfolio in line with your strategic weights and not spending too much time or transaction cost doing the rebalancing to keep you there. They also looked at combining calendar and threshold-based rebalancing, and they found that annual with a 1% threshold was optimal. Now the y-axis on these graphs is also relevant. You're probably wondering, what benefit do you expect from rebalancing? Well, you can see that in the best possible case, it makes a difference of about 0.5% per year. So not a huge benefit, but still pretty good. And we all like a result which shows that it's good to be lazy, and in fact that seems to be a consistent pattern across all of the research I've read. Generally, less rebalancing is better, within limits of course. So for a slightly more sophisticated portfolio, and this is from T. Rowe Price, they also showed that rebalancing has a return benefit, but notice how the larger the bands for the threshold-based rebalancing, the better the performance. The benefit that they measured wasn't particularly large, so the green boxes highlight the best performing strategies within each of the different allocations. But the general principle here is less rebalancing is better, wider thresholds are generally better. Now the relative bands here are interesting. If you've got lots of allocations in your portfolio rather than just 2, and some of those allocations are small, well, if it's an absolute percentage difference you're looking at, it's unlikely they're going to cross that boundary. So a relative band is a percentage of a percentage. So if it's 25% and you've got a 3% allocation to gold, well, it would be 3% plus 25% of that or minus 25%. So you just scale the thresholds according to the allocation. Now there are situations in which rebalancing hurts, and a really important case at the end of the video, so keep watching for that. But one case is when you have a very volatile market. Why is that? Well, remember what we said about transaction costs. When markets are very volatile, bid-offer spreads blow out. That's because market makers have to cover themselves, and consequently it becomes more expensive for you to trade. So if you're continually rebalancing, and remember when markets are volatile you'll be rebalancing more, then you'll be paying more to do that. So that's why the calendar approach and also thresholds combined with that usually work well, because during these volatile periods it may be that you don't rebalance again until the dust has settled, and you probably won't be rebalancing through the volatility. Another case is when you have a really strong bull run. So for example, there was a massive bull run in the US between 1987 and 2000. There were a few pullbacks along the way. You can see one in 1988, but it was fairly short-lived and not particularly deep. So if you had rebalanced during that bull run, then you'd have missed out on that equity rally. Now that's not necessarily a bad thing, because we all remember what happened after 2000. The dot-com bubble popped and you would have made a significant loss if you hadn't rebalanced. But this is a kind of scenario where you'll be tempted not to rebalance, and where if you do things correctly, you should be rebalancing. We'll come on to discipline at the end. But now let's talk about the big shock, or at least it was a big shock to me. And that's what happens in retirement. Now all the examples we've been looking at so far have been in the accumulation phase, when you're saving for retirement rather than post-retirement. It turns out that the whole nature of risk changes when you're in retirement. Suddenly it's not about capital growth, it's really much more about capital preservation. And in the results I'm going to show you, which is a paper by Spitzer and Singh, they actually say that risk in retirement is nothing to do with volatility. It's much more about how long your money lasts. That's because the risk in retirement is that you outlive your money. There might be volatility along the way, but as long as the money doesn't run out, then you'd have still succeeded. Now I'm going to use this graph to explain their results, and it's a little bit busy, so we'll talk through it and we'll build it up so you can understand what they're showing you. The first thing to say is what we're measuring is the risk of running out of money over a 30-year period. So you start off with a pot of money, you withdraw at a certain rate, so that might be between 3% and 7%, and then a failure is when you run out of money over that 30-year period. So red on this graph is a high failure rate, and that's bad. So you want white, you don't want red. Now the rows you can see on this table are the different withdrawal strategies. The one at the bottom is where you've got something like a life strategy fund, where you sell a certain slug of the fund, and that's selling equal proportions of stocks and bonds. So if you start off with Life Strategy 60, you'd end up with Life Strategy 60 after selling a bit. So that's your rebalancing withdrawal strategy. All the other strategies above that don't do any rebalancing at all. They either exhaust the stocks first, and then once all of the stocks are gone, you sell your bonds, and then you run out of money. Or you do the opposite. You sell your bonds first, then you sell your stocks, and then you run out of money. Alternatively, you could look at the previous year's returns and sell whatever had the lowest returns first, or whatever had the highest returns first. So those are the 5 strategies we'll consider in the table. The columns in the table represent the withdrawal rate, so that varies between 3% per year up to 7% per year. Now you're probably familiar with the 4% rule, that's the one that people often use. But this varied between below that and significantly above it. And it's not surprising that if you have a higher withdrawal rate, you're seeing a lot more red on the graph. If you hit your savings pot harder every year, withdraw more, you're more likely to run out of money over this 30-year period. And then finally, within each of the vertical columns, we've got little strips, and those represent the percentage of the portfolio which is in stocks, varying from 30% to 80%. So now we know everything we need to understand the graph. So here's what shocked me about this research. Selling your bonds first is the strategy that works the best. Now why is that shocking? Well, remember that with things like target retirement funds, Vanguard offers these. What you have is a glide path where, as a young person, you have lots of equity, then you gradually sell down some of the equity and have more bonds, so that you de-risk your portfolio as you get older. Well, this is doing the opposite. It starts off with some bonds early in retirement, but it gradually re-risks the portfolio as you get older. It sells all of the bonds so that you end up with 100% equity, potentially. The second shocking thing is that rebalancing helped very little. In fact, it had no measurable effect according to the authors of the paper. So if your strategy was to have, say, Life Strategy 60 in retirement and sell a little bit of it each month or each year, then that would automatically have been rebalancing on the way. But it turns out that's not optimal. So what I also take from this is that it's worthwhile splitting out your assets into different funds with different asset classes. And that way you can individually control which of the asset types it is that you're selling. And that means you can sell the bonds first of all. Now, to do the calculations for that paper, what they did was to scramble year-by-year returns. So they took every year between 1926 and 2003, which is just before the paper was published. And then they kind of threw a dice and said, look, we'll take returns for stocks and bonds from that year. Then they throw the dice again and choose another year randomly. And this way they can simulate out into the future for an arbitrary number of years. And it preserves the correlation of stocks and bonds. They also tried a different approach, which is to take returns in the correct order. So for every 30-year period, so for example, starting from 1926 to 1955, 1927 to 1956 and so on, they slid that window forward, the 30-year window, and simply replayed returns. So that generated 49 overlapping periods, and they reproduced the table, which you can see here. And again, what they see is that if you simulate returns in the right order and simply replay the past, you can see that bonds first was the strategy that worked the best. In fact, it seems to work even better than it did for the bootstrap approach, which is what they did previously. So while rebalancing really helps during the accumulation phase when you're saving for retirement, after retirement, that's not the case. At least that's what this research suggests. Or as the authors of the paper said, it provides no significant protection on portfolio longevity, which is after all what matters. How long's your money going to last? Secondly, re-risking by selling your bonds first is a strategy that works very well according to their simulations. Now that doesn't mean that it's going to work well for you. It may be that your risk appetite is not one that would be willing to live with a large amount of equity later on in retirement. You may simply not have the stomach for that kind of volatility, even if it's economically optimal. But if you are tempted to sell your stocks first in retirement, just make a note that that was actually an awful strategy according to their results. Now, the reason why the bond first strategy worked, selling the bonds first, is that it leaves the equities to compound for longer. And as we know, equities do very well if you just leave them to do that. And another one of the results, which is very clear from their data, is that the more equity you have in your portfolio generally makes your portfolio last longer, and it allows you to have a higher withdrawal rate in retirement. Now, that's something we all would like to have as long as we're happy with the volatility. But for people marketing target date funds, this is pretty bad news because it shows that that strategy doesn't work particularly well. So that was the shocker for me when researching this video, which is that in retirement, rebalancing doesn't help at all. But to summarize what I've taken home from this, the first point I think is that you should stick to whatever rules you choose. But most importantly, don't try and time markets. You might be tempted to say, oh, markets are looking a bit toppy, I'm a bit nervous, so I'm going to rebalance and sell some of my stocks. Don't do that. Use one of these rule-based approaches because it cuts emotion out of those decisions. It'll probably be less stressful as well. In the accumulation phase, when you're saving for retirement, then this combination of a calendar approach and a threshold approach works quite well. Just don't make the thresholds too tight and the rebalancing frequency too high. I find that once a year is enough, and I set the bands quite wide, probably more than 5%. Now in retirement, we've seen that selling the bonds first works well, and of course this is not one size fits all. You should always adjust these strategies to suit you. It's got to be a portfolio that you can live with. But do tell me if you were shocked by that result in retirement, the fact that rebalancing doesn't help. I was certainly surprised by that. And don't forget that as a viewer of PensionCraft, you get a special offer from the sponsor of today's video, Trading 212, where you can claim free fractional shares worth up to £100. All you have to do is open an account, verify it, fund it, use my name as the promo code RAMIN, R-A-M-I-N, and you'll find a link to that offer in the description below. And, as always, thank you for listening.